the only investment guide you'll ever need. Written and published by Books Reader. Introduction. At first glance, the stock market can seem like a terrifying place. You've probably heard stories of people losing all their money, of fortunes wiped out overnight. Then there are the confusing terms, convertibles, options, zero-coupon bonds. It's no wonder that many people ask themselves, can an average person really make money in the stock market? This summary will simplify investing for you. Before you can start growing your money, you need to save enough to invest. And before you invest, you need to understand how to minimize costs and protect your money from unnecessary risks. You'll also learn the importance of safe investments, especially when your account balance is still fragile. Once you're financially stable, this guide will introduce you to the essential concepts of stock trading. You'll discover how to decide when to buy and when to sell, and how to analyze your options beyond just buying company shares. Along the way, you'll also explore various investment methods and time-tested rules that can help you avoid common mistakes. Because here's the truth. The money you earn from your job alone is rarely enough to make you truly financially free. It might not even be enough to buy your dream home, a reliable car, or fund your children's education. That's why investing isn't optional, it's essential. The good news? The stock market isn't as complicated as it seems. Once you understand the basics and use your common sense, you'll realize that smart investing isn't just for Wall Street experts. It's for anyone who's willing to learn. A penny saved is 2 pennies earned. Many people don't realize that the income they earn from investments is also taxable. This can be a costly blind spot, especially for those who aren't familiar with how tax brackets work. Let's say someone earns $10,000 per month and pays $1,000 in taxes. That doesn't necessarily mean they're in the 10% tax bracket. It just means 10% is their average tax rate. In reality, income tax is graduated, which means you pay different tax rates on different portions of your income. The first few $1,000s might not be taxed at all. But as your income increases, so does the tax rate. In the US, some people end up paying as much as 35% on the last few $1,000s they earn. For self-employed individuals and business owners living modestly, their marginal tax rate can reach 50%. Now imagine you're just below that 50% threshold. You make an investment and earn $1,000 in profit. That extra income pushes you into the higher bracket, and suddenly, the government takes $500 of that gain. Half of your investment income is gone, not to benefit you, but to make the government wealthier. This shows why trying to get rich by simply earning more money isn't always effective. Sometimes spending less is a smarter and more powerful strategy. For example, if you resist buying the latest iPhone and save $1,000 instead, you don't pay tax on that saved money. That's why a dollar saved is worth even more than a dollar earned. If you pause and look around, you'll find countless opportunities to save money. Take wine, for instance. Many Americans like to buy a bottle of red wine every weekend. A decent bottle costs around $10. But if you buy a case of 12 bottles, you usually get a 10% discount, which means you pay about $108 instead of $120. That's a saving of $1 per bottle, $52 per year. Now let's analyze this like an investment. Normally, you'd spend $10 every week on a bottle. But by buying in bulk, you spend $108 all at once every 12 weeks. That $98 upfront is like your investment, and the $52 you save annually is your return. That's a return of over 50%, better than what most people make in the stock market. Another simple yet powerful way to save is by avoiding unnecessary interest on your credit cards. Around 60% of Americans pay more than 18% interest on their credit card balances, even when they have money sitting in a savings account earning just 2%. That's like losing money while pretending to save. If you use your credit card wisely, you can actually make money. Some cards offer cash back up to 2% on every dollar you spend. Look for cards that provide year-end bonuses or discounts on hotels, restaurants, or flight bookings. Used correctly, these small perks add up. The same vigilance should apply to your bank loans. Always double-check your interest rates and monthly payments. The author, Andrew Tobias, once took out a $400,000 loan at 7.5% interest. A year later, the bank reduced his rate to 7%, but his monthly payment of $4,670 seemed slightly off, about $10 higher than expected. That seemed minor, but on closer inspection, he discovered the bank had quietly enrolled him in a $7,000 insurance plan. If he hadn't followed up, he would have overpaid without ever realizing it. Young people often dream of owning fancy cars and get lured into leasing or long-term financing deals. But cars don't last forever. After a few years, you either trade them in or spend more and more on repairs. That's why buying a car on credit isn't always a wise move, unless you can actually afford it up front. That doesn't mean you should never own a car. It just means you should wait until you can truly afford one. There are plenty of fuel-efficient second-hand cars available in the market. A budget-friendly car today might help you save enough to buy a brand new one tomorrow without debt. As you grow older, your priorities shift. Flashy cars and luxury items lose their charm. Instead, medical care becomes one of life's major expenses. One smart way to cut those costs is to talk to your doctor about generic medicine brands. Big pharmaceutical companies often sell expensive branded drugs, while smaller manufacturers offer the same medications at a fraction of the cost. You can even ask your doctor about buying larger doses and splitting them. Andrew Tobias, for example, saved 50% on his heart medication by purchasing a stronger dose and using half a tablet per day. Of course, staying healthy is the best way to reduce medical costs, and fitness doesn't have to be expensive. Many people waste money on gym memberships they rarely use. Unless you're a bodybuilder or an athlete, you can stay fit with simple at-home exercises, push-ups, squats, and crunches. Just walking around your neighborhood can do wonders for your stamina. For most people, fancy equipment and gym fees are unnecessary. Just like physical health, mental development, and lifelong learning are essential. Reading is one of the best ways to grow, and the cheapest way to build this habit is through a library membership. In many places, a full year's membership costs less than buying 2 or 3 books. That's an incredible return on investment for your personal growth. The case for cowardice. There's a famous saying in the world of finance. One big risky investment can make you more money than a lifetime of playing it safe. And it's true. Sometimes, a single bold move can change everything. But the truth is, very few people ever find that one great investment, especially if they're not professional investors. For most of us, there's a more relatable quote to live by. You get what you pay for. If you want big returns, you have to be willing to take big risks. But that doesn't mean you can't earn solid profits through safer investments. In fact, for everyday people, playing it smart often beats playing it big. Yes. Investing in stocks can offer higher rewards than safer options, but before you get there, be prepared for the reality. You might face 5 straight years of losses before seeing any meaningful gains. That's why stocks are only suitable for people who already have a solid financial cushion, enough savings to cover the next few years regardless of what happens in the market. If you're just starting out and haven't built up substantial savings yet, there are 2 types of safe investments worth considering, short-term and long-term. Which one you choose depends on when you'll need access to your money. Let's begin with short-term options. One of the most reliable is the money market fund. These funds collect money from many investors and lend it to governments or large, stable businesses. The goal is to ensure the loans are repaid and the interest earned is distributed among the investors. There's no guarantee of consistent monthly payouts, but if you choose a fund with low fees and a strong reputation, usually offered by major banks rather than obscure financial firms, you'll be on the safer side. Then there are treasury bills, considered some of the safest short-term investments in the world. Essentially, you're lending money to the government. In the US, you can buy a treasury bill for as little as $100 and sell it back after 1, 3, 6, or 12 months. These bills often pay competitive interest rates, and since they're backed by the government, they're about as close to risk-free as it gets. For long-term goals, there are treasury notes and treasury bonds. These work like treasury bills, but with longer durations. Notes typically mature in 2 to 10 years, while bonds stretch from 10 to as long as 30 years. Over time, stocks generally outperform bonds in terms of returns. But during times of economic crisis and high interest rates, treasury bonds become a safer, more attractive choice. There's a downside, though. The profits from treasury securities are taxable. That's where municipal bonds come in. These are similar to treasury bonds, but are issued by city governments instead of the federal government. For example, you might be lending money to New York City rather than to the United States as a whole. Municipal bonds are often tax-free and nearly as safe as treasury bonds. Why? Because national governments rarely allow their cities to go bankrupt. However, if a city does experience financial hardship, you might not see your money for a while. These bonds are safe, but not always liquid. It can take years for cities to restructure their finances after a crisis. Another long-term option is convertible bonds, loans you make to a company that pay regular interest. But here's the twist. You have the option to convert them into company stock. This gives you the potential for high returns if the company performs well. If the company is struggling, stick with the guaranteed interest payments. If the company is growing, you can convert the bond to stock and sell it later at a profit. Of course, you'll need to do your homework to time the conversion right. If you don't have the time or interest in researching, it's better to avoid convertible bonds altogether. Then there's one final type of long-term investment worth considering: zero-coupon bonds. These don't work like regular loans. Instead of receiving interest over time, you buy them at a discount and redeem them later for a higher fixed amount. For example, in 1994, Andrew Tobias invested in zero-coupon bonds from Revlon, a cosmetics company. He bought them at just 43 cents each. And 4 years later, they paid $1 per bond. That's a return of over 130%. The catch? If the company had gone bankrupt, he would have lost it all. Still, the bonds were so cheap that the risk seemed small compared to the potential reward. Safe investments like these are excellent when you're just starting your financial journey, but don't expect them to make you rich. Even if you save 20% of your salary consistently for 40 years, you might only have enough to cover about 8 years of expenses in retirement, and that's before taxes and inflation eat away at your savings. At best, safe investments might stretch your retirement funds by a few more years, but they won't be enough on their own. Eventually, to truly build wealth, you'll need to accept the risks of the stock market. The good news is those risks are easier to handle when you've already secured part of your money in safe, reliable investments. That foundation gives you the confidence to take bigger steps and to weather whatever storms come your way. Meanwhile, down at the track, now that you've built a decent savings buffer and some of your money is quietly growing through safe investments, it's time to look at the stock market. Why? Because investing in stocks is one of the most effective ways to beat inflation. Inflation is the invisible thief that makes your money worth less over time. Just think back to your childhood. Didn't everything seem cheaper back then? That's inflation in action. And if, say, you had invested in treasury bonds 10 years ago, you might be disappointed to learn that while the prices of goods and services have skyrocketed, the interest on your bonds has not kept up. Now imagine you had instead invested in a business, say, a soap manufacturing company. Over 10 years, the price of soap has likely increased. That company's profits and overall value would have grown to keep pace with inflation, maybe even faster. This simple example shows why the stock market is uniquely positioned to help you outpace inflation. Let's look at some real numbers. One historical study compared the performance of U.S. Treasury bills, corporate bonds, and stocks from 1926 to February 2015. Treasury bills returned about 3.7% per year. Corporate bonds averaged 5.9%, while the stock market surged ahead at 9.8% annually. To put that in perspective, if you had invested $1,000 in Treasury bills in 1926, you would have had around $20,530 by February 2015. But that same $1,000 invested in the stock market would have grown to over $2,500,000. And it doesn't end there. Stock investing can be tax efficient. When you sell stocks for a profit, that money is called capital gains, and it's often taxed at a lower rate than your salary or bond interest. On top of that, some companies pay out part of their profits to shareholders in the form of dividends, which are also taxed at a lower rate and don't reduce the value of your stock. People often fear the stock market because it seems complex. But when you strip it down, there are only two basic ways to make money from stocks: dividends and capital gains. Everything else in investing revolves around these two principles. Likewise, there are only two forces that move stock prices: fear and greed. Prices drop when investors fear a company will underperform and rush to sell. Prices rise when investors get greedy, believing a company is poised for strong growth and everyone piles in to buy more shares. The first secret of smart investing is to buy when prices are low, but many people do the opposite. They invest when the market is soaring. The problem? When prices are already high, there's less room for growth. The best time to buy is when prices are low and the stock has space to climb. Also, never put all your money into just one industry. Stocks in the same sector tend to rise and fall together. If Microsoft takes a hit, Apple might not be far behind. To avoid major losses, diversify your portfolio by investing across different industries. Ironically, the most popular stocks are often the ones you should stay away from. If everyone is already investing in a particular company, there's little value left to gain. Those shares are often the first to fall when the hype fades. Perhaps the most important skill in investing is knowing when to sell. Many people panic and sell just because they hear someone say the market is going to crash. That's the wrong move. You should only sell when you believe the stock's price has risen far beyond the actual value of the company, when it no longer makes sense to hold it. Of course, not every individual stock investment will succeed. Sometimes, right after you buy, the company starts losing money. That's why many investors turn to mutual funds. These funds are managed by financial professionals who pool money from many investors and strategically invest it across a range of stocks. Sure, individual companies can fail, but over time, the market as a whole tends to grow. A good mutual fund spreads its investments across strong businesses in various sectors. Even during rough years, strategies like dollar cost averaging can help you come out ahead. Let's say you decide to invest in a mutual fund called Scoff Illustration Fund and commit to putting in $3,000 every year. In the first year, the share price is $25. In the second year, it rises to $45. In the third year, it drops drastically to $5. Then, in the fourth year, the price bounces back to $25. Over those 4 years, you invest a total of $12,000. 4 years. Your $3,000 buys you 120 shares each. In year 2, the high price only gets you 67 shares. But in year 3, when the price is at its lowest, your $3,000 gets you 600 shares. That's a total of 907 shares. Now if the share price settles at $25 again, your 907 shares are worth over $22,000. Even though the average share price over 4 years was $25, the same as your starting point, you've made over $10,000 in profit. Why? Because you bought more shares when the price was low. That's the power of dollar cost averaging, investing a fixed amount at regular intervals regardless of market conditions. Over time, this approach helps you buy more when prices are low and less when they're high, improving your average return. Choosing to ignore your broker. A stockbroker is someone who holds a license to buy and sell stocks on your behalf. As an ordinary investor, you can't trade directly, you need a broker. Most brokers also act as financial advisors, guiding you on when to buy or sell and suggesting which stocks to pick. The problem: very few brokers consistently outperform the market. And the truly skilled ones, the kind that billionaires trust, charge more than $500,000 a year. That puts them far out of reach for the average investor. Still, you'll see plenty of ads promising cheap brokers who consistently beat the market. But often, these claims are based more on luck than skill. Imagine this experiment. You gather 256 people in a room and flip a coin. Half choose heads, half tails, 128 guess right. Do this 8 times, and according to the laws of probability, one person will get it right every single time. Does that make them a genius or just lucky? The stock market works the same way. Every year, half of all brokers do better than the market, and the other half do worse. Now imagine if those with poor results kept quiet about their failures and only advertised their best years. That's exactly how many brokers market themselves, as if they've cracked the code when in reality, they just had a lucky streak. Another issue? Brokers rarely have time to study the market in depth. They're constantly chasing new clients, pitching investment packages, making calls, handling paperwork, and executing trades. At their core, many are salespeople. The ones who do actual market research are called investment advisors, not brokers. But even professional analysts don't always get it right. Take this story. In 1967, the editors at Forbes conducted a quirky experiment. They pinned a copy of the New York Times business section to a wall and threw 30 darts at it. Wherever the darts landed, they invested $1,000 in that business. Over the next 15 years, their $30,000 investment grew to around $72,000, a 240% gain. In comparison, the overall market grew just 35% during the same time. Interestingly, half of all investment advisors underperformed the market during those years. So, what's the takeaway? Both brokers and advisors earn commissions. That means every time you make a trade, a portion of your money goes into their pocket, whether or not the trade benefits you. Often, these fees are buried in the fine print, but they add up fast. Andrew Tobias once calculated his own brokerage fees over the course of a year and found they were his second largest expense after rent. Naturally, brokers want you to trade as often as possible. That's how they make money. So don't expect them to advise you to sit still and do nothing, even though sometimes doing nothing is the smartest move. Because of these costs and conflicts of interest, your best bet is to avoid brokers who offer advice altogether. Instead, look into discount brokers. These are low-cost services that simply execute the trades you tell them to. No upselling. No unsolicited advice. And if you want a smarter, low-maintenance approach, consider index funds. These funds are designed to mirror the performance of a specific market index, like a list of top-performing stocks. One of the most well-known indexes is the S&P 500, which tracks 500 of the largest companies in the U.S. It's published by S&P Global, a trusted financial agency. When the economy grows, so does the S&P. When the economy weakens, the index may dip. But the beauty of index funds is that they don't require active management. In fact, many of them are fully automated, which keeps their fees incredibly low. By combining index funds with dollar cost averaging, investing a fixed amount at regular intervals, you can quietly outperform many experts over the long run. No constant trading, no emotional decisions, just steady, consistent growth. Hot tips, inside information, and other fine points. Once you start investing regularly, your journey won't just stop at bonds, mutual funds, or standard stocks. As your experience grows, you'll come across various other investment methods, some exciting, others risky. But before you jump in, there are a few critical lessons every smart investor must know. First, never blindly trust investment tips or hot information no matter who gives them to you. Politicians and high-level insiders often make investments based on privileged data not available to the public, a practice known as insider trading. It's illegal for good reason, and chances are the so-called news your friend shares with you is already several weeks old. At the end of the day, you alone are responsible for your money. Financial companies may dazzle you with flashy offers and clever advertisements, but many of them either hide key facts or distort the truth, especially insurance firms and fund managers. Take this example. Andrew Tobias once saw an ad for a mutual fund that claimed an impressive 21.5% annual growth over the past decade. According to their math, investing $2,000 for 20 years could turn into $90,000. Sounds amazing until you dig into the numbers. The growth rate was calculated in a misleading way. The fund had indeed seen high returns in 6 years, but those were completely cancelled out by losses in the other 4. So anyone who had invested 10 years earlier might have actually lost money. That 21.5% growth figure, just marketing spin. Annual reports are also not always what they seem. While many believe that a company's yearly report is the best way to evaluate its health, in reality, those reports are designed to boost investor confidence. The good news is splashed across the first few pages in bold print, while the bad news is buried in dense charts and footnotes. You'll rarely find meaningful insights unless you know exactly where and how to look. Now let's talk about a few advanced investing strategies. One popular but risky technique is called short selling. Usually, you buy stocks hoping their value will rise. But in short selling, you bet the price will fall. You borrow shares, sell them at the current price, and later buy them back at a lower price, pocketing the difference. The risk? If the stock's price rises instead of falling, your losses could be huge. For instance, if the stock price doubles before you buy it back, you lose twice what you hope to gain. And in extreme cases, a stock might rise 10 or 20 times its value, leaving your account wrecked. Short selling can be a financial minefield. Then there's margin trading, another way to amplify gains and losses. Here, your broker lends you money to buy more stock than you could afford on your own, but there's a catch. They hold your shares as collateral. If the value drops too low, they'll sell your shares without warning. Margin loans also come with higher interest, typically 5% more than regular bank loans, so using margin to buy stocks is rarely a good idea. That said, it's still cheaper than racking up credit card debt. So, if you absolutely must borrow before payday, margin loans are the lesser evil, but use them sparingly and wisely. Let's move on to options trading, a way to make investing more flexible and thrilling. Typically, when you buy stocks, you should hold on to them for at least a month, but with options, you can trade within days or even hours. An option gives you the right, but not the obligation, to buy a stock at a specific price by a certain date. For example, Andrew once noticed that shares of Merrill Lynch were stuck at $16, even though the market had recently risen 15%. He believed the stock was undervalued. So, he bought 10 options, each allowing him to buy 100 shares at $20. He didn't need to pay the full $20,000 upfront. Instead, he paid just $375, $37 per option. This gave him the right to buy Merrill Lynch shares later if the price rose. And that's exactly what happened. As the stock climbed to $20, the value of each option soared to $300. Andrew sold 2 options to cover his costs and let the others appreciate further. By the end of the month, he sold all the options at a high and walked away with $2,400 in profit without ever buying a single share. What if you expect prices to fall? That's where puts come in, options that allow you to sell at a fixed price in the future. Let's say a stock is trading at $75. You buy a put that lets you sell it at $70. If the price drops to $51, you buy 100 shares for $5,100 and sell them for $7,000, making a $1,900 profit. Puts are essentially a safer version of short selling. Your maximum loss is limited to what you paid for the put. They give you downside protection without unlimited risk. Lastly, let's talk about taxes. You owe tax on profits from your investments, but you can also use losses to your advantage. By selling underperforming stocks at a loss, you can offset gains and lower your taxable income. This is especially useful if you've had a successful year with several short-term gains. If you're holding a few bad stocks you don't believe in anymore, it may be wise to sell them at a loss before the year ends just to reduce your tax bill. It's called tax loss harvesting, and it's a smart way to soften the blow of capital gains taxes. As you've now discovered, the first step toward building real wealth doesn't begin with investing. It begins with saving. Every dollar you save is tax-free and 100% yours. Shop in bulk to take advantage of discounts, pay your credit card bills on time, and don't buy a car unless you can pay for it upfront. Always keep track of your loan repayments and medical expenses. These small habits can lead to major financial stability. Second, you've learned that before diving into risky ventures, you must build a strong financial foundation through safe investments. In the short term, this could mean putting your money into treasury bills or money market funds. For the long haul, you can consider treasury bonds, municipal bonds, and zero-coupon bonds. And if you're ready to step closer to the world of stocks, convertible bonds offer a smart bridge. Third, you've seen why stock trading plays such a vital role in long-term wealth creation. It's one of the only ways to consistently outpace inflation. But timing matters. Buy when prices fall, not when hype is high. Popular stocks are often the worst investments because they leave little room for growth. Instead, diversify across multiple industries and use strategies like dollar-cost averaging, investing a fixed amount each month to grow your portfolio with discipline and consistency. Fourth, you now understand the hidden costs of relying on brokers and financial advisors. Most brokers spend more time selling than studying the market, and even expert advisors struggle to consistently outperform the market. In truth, their goal is often to keep you trading because that's how they earn their fees. That's why discount brokers or index funds are often better options. They minimize costs and maximize simplicity. Fifth, you've explored more advanced investment strategies. Don't blindly trust hot tips or secondhand information. Be especially cautious with short selling as losses can quickly spiral out of control. Treat margin loans like short-term tools, not long-term strategies. Learn about options and puts. They limit your risk to the amount you've invested. And remember, even losses can be used strategically. Selling poor-performing assets at the right time can reduce your tax burden and strengthen your financial plan. The stock market may seem like a complex web of risk and opportunity, but the truth is, successful investing is grounded in simple principles. Understand how the market works, stick to the basics, make thoughtful decisions, and above all, stay consistent. This summary has equipped you with the essential rules of investing. You now have the tools and the mindset to build a future of financial security, freedom, and peace of mind even after retirement.